This
Right. Are
conference
we,
will now be recorded.
All right.
will we have to, those of us who have our mics on, are you going to call on us or can we just listen to you? I don't want to be quizzed.
You guys can self-mute. If you do have a question, chime on in.
Okay,
Okay. No, I don't put people on the spot.
great.
Okay. Maybe in class, live class, we're in the classroom. I might do that once in a while, but for the most part, no. Okay.
Okay.
All right. So I'm going to roll through the material. If you do have questions, chime on in. If you do need a little more clarification, let me know. I do have access to my flash drive with all my other supporting documents if I need to, move over into that also. So, but it's kind of a little more of a Q&A. I'm going to review some information. Hopefully it triggers some items. We are going to dive a little bit more into the general insurance concepts and definitions because it's a huge part of the test and you got to get the basics down. That's the foundation that's going to trigger and I should say filter into other areas of your exam. All right. So I think pretty much everyone's registered, so I'm going to pass that. You got to just start with the name of the test that you're taking. It's the property and casualty exam, or sometimes you'll hear fire and casualty exam. That means property and fire are interchangeable. A property loss is the same as saying a fire loss for this exam. All right. And property covers your stuff, your house, your car, your boat. All right, so you are what we call the first party. I'm using you as being the insured, buying the insurance, protect yourself. Okay, so the insured is the first party to a contract. They're buying the contract from an insurance company. The insurance company is a second party to a contract. So insurance in general is simply a two-party contract between the insured, the customer, and the insurer, the insurance company. Can't get much more personal than that. So if it's a two-party contract, anyone other than those two is a third party. And that's over here. And liability makes up most of the casualty arena, okay, covering you injure someone else or damage someone else's property. So you injure them or you damage their stuff. So property covers your stuff, liability covers their stuff. I always say whenever you hear the word L in liability, think L for lawsuit, right? Because liability protects against lawsuits. You injure someone else, you damage their property, and they're going to sue you to pay for it. And so liability claims are all third-party claims. Now, there could be multiple third parties. So there's no such thing as a fourth, fifth, or sixth party. Anyone other than you and the insurance company is a third party. And like I said, there could be multiple third parties. Okay, so keep that in mind. Another area of casualty insurance is workers' compensation. All right, it's a casualty type of coverage which protects you as an employee if you're injured while engaging in activities for wage or profit. Yeah, that's how your test works. You're injured while working. Okay, injured while engaging in activities for wage or profit or under the course of employment. Your test goes a little crazy with the language. You want to kind of embrace it. I mean, here and there, you're like, why would it drop it? Drop the why stuff. Just this is how it is. This is how you need to know it just to pass this test. Now, once you pass this test, a lot of this stuff will go out the window. All right, we just kind of touched on that. Specifically, the language, the definitions. So, first of all, insurance. That's what we're all about. So, insurance is a contract to indemnify or restore you to what you had prior to a loss. So the loss must be uncertain. So insurance protects you because you suffered a loss from an uncertain event. Now you're going to get a couple questions on insurance. I just don't know which verbiage they're going to use. You might get it as a one-word answer. Insurance is defined as which of the following. And then you got a bunch of C words. It's conditional, contemplative. You want to look for it's a contract, okay, for the one-word definition. But it's a contract to indemnify another against loss, damage, or liability arising from a contingent or uncertain event, which we'll get into. So it's a contract of indemnity. And indemnity means to just restore you to what you had prior to a loss. So if it's a 3-bedroom, 2-bath house and it burns down to the ground, we're going to cover the cost to rebuild the exact same 3-bedroom, 2-bath house you had before the fire. We're not going to give you a 5-bedroom, 3.5 bath house with a sun deck, a pool, jacuzzi, and some skylights that you didn't have before the fire, because that was a gain. And insurance is to restore you to what you had. Excuse me, not give you a gain. Right? Now, in order to buy insurance, you have to have insurable interest. Insurable interest means in order to insure something or somebody, if that something or somebody were to suffer a loss, it's got to affect you financially. That's how you want to view it. Excuse me. Now, I say you got to have a financial interest. The test a lot of times will use economic interest. So they went a little crazy with the thesaurus. That's all they did. Okay. That means you can insure your house because if your house were to burn down, it's going to cost you money to rebuild it. So there's that financial or economic interest in your property. You could not insure your neighbor's house because if your neighbor's house burns down, financially it doesn't affect you at all. Emotionally, you might be a little distraught, like, oh my God, those poor people, they're such good people, right? But financially, there's no effect. And if there's no financial effect, there's no insurable interest, and you cannot buy a policy on it. Adhesion. Probably get this twice. I'm drinking water. I don't know why I still got this cough here. All right, so so adhesion. Think of adhesive tape. We the company, we print up the contract. It's in our language. Right? So if the contract's unclear, ambiguous, general, or vague, it's kind of our fault. All right. So if a loss occurs and it's unclear whether or not coverage applies, guess what? Coverage will apply. The insured or the customer will actually win. All right. Because it's a contract of adhesion. Another definition for adhesion is it's a take it or leave it contract. Since we print it up, it's in our language. You can take it or you don't have to. You can leave it behind and go buy a policy someplace else. All right. So that's adhesion. See, you're learning this definition, but when you're sitting with a prospect, you're not going to use this language. You're not going to say, oh, it's awesome. This is a great homeowner's policy and good for you. It's a contract of adhesion. You're not going to say things like that. So see, you're learning a bunch of stuff just to pass the test. It's just going to go right out the window. Okay. Aleatory is kind of built in the definition of insurance, which means the loss must be uncertain. So, you might see aleatory or aleatoric contract, but performance depends on an uncertain future event. Your house may burn down, it may not. You see, that's what aleatory means. Now, another definition for aleatory is you might see is listed as unequal distribution, or you might get more or less than what you paid for. All right. And that's kind of strange to hear that you may get more or less than what you pay for an insurance. All right. But let's say someone buys a brand new car. In order to drive the car off the lot, they got to have insurance. So they meet with the insurance agent, fill out the application, pay the first month's premium. The agent gives them a binder, which is a receipt for payment of a premium. Okay? And it's unconditional, by the way. Binders are good for about 30 to 45 days in the real world. For the test world, they're good for 90 days, and that's it. But basically, you paid premium. We're going to give you a receipt, which means if you suffer loss in possession of this binding receipt, even if you lie on the application, you're covered. Okay. And so binders are just like the name implies, they're binding the insurance company. Okay. So the customer fills out the application, pays a premium, gets a binder, hops in a new car, waves to everybody as they drive off the lot and just drive into a semi truck passing by and total the brand new car. Now, they paid 1 month's premium, and with a binder, they got a full payout of a replacement vehicle. So they got more than what they paid for in that contract. Now, that may bother the agent, but it really doesn't bother the insurance company like you're thinking. Because even though this person paid 1 month's premium and got a full payout of a brand new replacement car, we have thousands of policyholders that'll pay premiums the rest of their lives, and a lot of them will never, ever file a claim. And so they apparently got less than what they paid for in a contract, you see. So that's where we get that unequal distribution, all right? You may get more or less than what you paid for. That's what aleatory is all about. And again, you're learning a definition just to not use it after you pass this test, Okay, so all right, a contract. Well, insurance is a contract. Contracts don't have to be in writing. Okay, insurance contracts must be in writing. So keep that in mind. You can have a verbal contract with your friends. Hey, why don't you come over and help me move this weekend? You know, you show up and help me move. I'll give you pizza and beer. And they say, yeah, no problem. We'll show up and help you. And so it's a promise, a pizza and beer for a promise of doing work and helping you move. So it's a promise for a promise, which is a bilateral contract, and most contracts are bilateral. It's an equal distribution, right? Insurance contracts are unilateral. It's one-sided. It's an act for a promise. It's the act of filling out the application and paying a premium for the promise of receiving benefits. That's why insurance contracts have to be in writing because it's unequal. Bilateral contracts don't have to be in writing. All right. I already said it's a conditional contract. Well, no, not yet. Sorry, I'm thinking of something else. Insurance contracts are conditional because if a loss occurs, there's conditions that you have to fulfill in order to collect. So you have to meet certain conditions in order for the policy to pay. That's all that is. Personal contract we discussed. It's between you and the insurance company. Two-party contract. Again, cannot get much more personal than that. Unilateral. Again, a whole nother language for you. This is more so on the life test, but you might get this definition on the property and casualty test. And keep it simple. Uni meaning one, lateral meaning sided. Okay, so it's a one-sided contract. All right, we got a hand raised. All right, Janine, you got a question?
Yes.
Go ahead.
Um, are we supposed to be seeing your screen?
Oh, you cannot see the screen? Oh my
I
God.
I can't.
What do those young kids say? My bad. Uh, Sorry.
Yeah, I can't see it either.
Oh, now you tell me. Oh man. All right. There. How's that? Terms to know.
Oh, there it is.
All right. Sorry. Sorry.
Yeah,
Sorry.
thank you.
Okay. Let me go. Let me go back. This is the first screen. All right. Remember the exam name. You and your stuff versus we versus us, or we and us as the insurance company, I should say. Liabilities, them or their stuff. Okay. All right. So we're on this page. I'm sorry, we just covered this first line. Sorry. Okay. All right. Hold on. Let me have them drop some noise. Okay. All right. Here we go. All right. So now you guys can see it. Okay. We're good. We're good.
Yes.
All right. Thanks for letting me know. All right. Awesome. Awesome. All right. So risk. Risk. Look for the keyword uncertainty. Risk is defined as uncertainty of a loss. Okay. I mean, your house may burn down. It may not. It's uncertain. Okay. All right. I'm going to mute you over here. If you can't self-mute yourself, if it's too much noise, I'll mute you. Okay. All right. So risk is uncertainty of a loss. We have two types of risk you want to be aware of: pure risk and speculative risk. Speculative risk is possibility of loss or gain. Think of gambling. You can win money, you could lose money. Yeah, you could break even. And so there's a possibility of loss or gain. That's speculative risk. That's the type of risk we are not going to insure. Okay. See, if you can get a gain out of insurance, we're not going to issue the policy. Or if you did buy the policy, we're going to limit what you can collect because you cannot get a gain in insurance. Okay, fair enough. We only insure pure risk, which is the possibility of loss only. All right, so if your house burns down, we cover the loss. Remember that 3-bedroom, 2-bath house? We cover that loss to rebuild it. We're not going to rebuild a 5-bedroom, 3.5-bath house with a pool and everything else because that improved your condition, and that's not what we're about. Okay. Peril, you're going to get all over this test. Okay. So you got to get this definition done. Peril is defined as a cause of a loss. All right. Fire, explosion, flood, cancer, AIDS, those are common perils. They cause losses. And you need to understand that because a lot of this test is going to be discussing which perils are covered, which perils are not covered. Right? Um, and so get that down. And then you have cause of loss forms. Now, this gets kind of funny, but if a peril is a cause of loss, a cause of loss form is a form that lists perils. All right. So it's either going to list perils that we cover, which is the name peril form, right, like basic broad, or it's going to list perils we exclude, which would be all risk, open peril, or special form. So these two are opposites of each other. This list perils, if it's on the list, if something happens, it's on the list, it's covered. But if it's not on the list, it's not. But for all risk coverage, we list exclusions. So if something happens and it's not on the exclusion list, it's covered. Okay. So again, this lists what we cover. This lists what we don't cover. Okay. And you got to get them down. Anytime you see all risk, open peril, special form, always, always, always pay attention to the exclusions. If it is not on the exclusion list, it's going to be covered. Okay, so it's the more comprehensive coverage. The test will trick you, and they'll say which of the following has the broadest coverage. Basic, broad, special, or none of the above. And when you hear broadest coverage, you're thinking broad form, and that would be wrong because the special or all risk coverage is the broadest. All right, broad form is broad. Well, broad form perils, that's the name of a cause of loss form, but it's broad, it's named perils, but the broadest coverage is all risk. So if this causes loss, hazards are conditions that would increase the likelihood of a peril or a loss occurring. You have badly worn tires on your car and you're driving in one of the first rains of the year, okay? You're more likely to have an accident because you have badly worn tires. That means if you hit the brakes, you're probably going to hydroplane and not stop in time and hit whatever the object is ahead of you. And so the badly worn tires would be a physical hazard, which increases the likelihood of you getting to an accident. So the accident would be a peril. It's a cause of a loss. The badly worn tires made it more likely for you to get into that accident. That's how you need to understand that. So hazards are like catalysts to perils or a catalyst to having a loss. The badly worn tires, physical hazard. Once in a while on your test, you'll say living next to an explosives factory would be defined as which of the following. That would be a physical hazard because it's an explosives factory. Okay. You can reach out and touch it. All right. Moral and morale, you got to get the difference between these two down. Probably 2 questions, know the difference. Moral ends in an L. L is for lying, cheating, being dishonest. For those of you that work in an insurance office, welcome to the world of auto insurance. People will lie to your face, right? Because when they come in for auto insurance, you ask them. You even let them know, hey, we're going to look it up, but I still got to ask you, have you had any tickets or accidents in the past 3 years? And they'll simply say no. And then you look it up and they've got like 4 tickets and 2 accidents in the past 8 months. And then you realize there's another page. They lied to you. Now, a lot of your companies, you'll still write them. You're just going to charge higher premium. Right? But that tells us a little bit about their personality. Okay. Lying, cheating, being dishonest. And where it does come into play with people on the claim side, okay, that are lying about a claim. But that also can go into legal hazard, which we'll get into. But typically for the test, moral, someone has a tendency to lie, cheat, be dishonest. Morale, break it down to more ale. All right, when you drink more beer, you got that liquid confidence, huh? All right, because when you're drinking, you tend to do things and take more risks that you normally wouldn't do. But that liquid confidence and all the egging on by all your friends, you might want to take more risk. And that's what morale hazard is. Someone who drives fast, maybe they participate in high-risk hobbies like skydiving, scuba diving, and things like that. They're a risk taker. On the test, they defined it as someone who has an indifferent attitude. Okay, that's how you want to understand that. Right? Legal hazards are people that are going for more money than they're legally entitled to. They malinger after a claim. Now, again, this is the language that you'll see on your test. Malinger after claim. Who the hell talks like that, right? That means you had a workers' comp claim, you're injured, and there's no incentive to get healthy and get back to work because you're getting paid the same amount of money sitting at home playing PlayStation as you would earn while working. where's the incentive to go back to work? Okay. And so you drag your feet in getting healthy, going back to work, which increases the claim for an insurance company. Okay. And even if they do try and fight it, they got to hire people to defend it, which costs money to the insurance company again. Right? And so legal hazards are those people that are going for more money than they're legally entitled to. And guess what? We're all paying for it with higher premiums. That's how you need to understand that. Okay. All right. I had someone else put in a comment. Sorry. Which part? The one about malingering after a claim? Janine? Yeah. Okay. So yeah. So someone suffers a workers' comp injury and they malinger after a claim. That means that they don't go through the physical therapy and get healthy and get back to work. They're dragging their feet on going back to work because they're making the same money on a disability. All right. That's what it is. But the test uses malinger after a claim, and it's either a disability income or for this test, it's usually a workers' comp claim. Okay. So. Thanks for chiming in. Yeah. And yeah, just jump in, you guys. Okay. So these are definitions. If you are on my website or when you get on my website, make sure you review the playbook. So right under the sample test questions, right under the quizzes, there's the playbook, and then there's charts, like dwelling coverages, homeowners policy, so you can help understand the differences between the coverage parts. But the playbook is kind of like a virtual flashcard set. I have the term and I have the definitions you want to associate with it, and kind of a little bit of an explanation, and I keep adding to it. So, okay. All right.
Yeah, it made so much more sense when you said indifferent attitude would be morale, because on the test I like remember something like that because they use like really weird terms.
Yep. Oh, I know. Oh my gosh, it's comical to me. You guys are like, oh God, it's so tough. To me, it's like, wow, that's pretty cool how they word that. So that's just me. All right, thank you. I look at it from a different vantage point than you guys. So if I go in there and take the test, I got to remember, oh shoot, I got to fail this thing so I can take it again and update some of my material. Okay. So you recommend, it's up to you, okay, as far as making flashcards out of the playbook. I think you were in my class, so you actually have a hard copy of the playbook, I believe, right? So you wouldn't need to just use the playbook. Yeah, usually if I have a live class and you show up, I actually give you a copy of the playbook. Some people, I don't know. I've never had that issue where they have to write it down a couple times, or they don't get it. I couldn't answer to that because I've never really done that. I just take a couple little notes. My mindset's probably different than a lot of people. Um, if I'm interested, I'll absorb it. When I first started my career in selling insurance, I was very interested, so I'd watch other agents' presentations and I'd absorb it to where I can mull it over in 5 minutes, and then I can actually pitch that presentation. That's just me. Okay. Yeah, I'm that guy. So if you want a hard copy, oh yeah, you have a hard copy. Okay, yeah. So okay, then yeah, just run through that playbook. In fact, on the day of the test, that playbook and the charts are probably the only thing you should study. If you're going to study the sample test questions, you can study them all day, every day, up until the day of the test. On the day of the test, do not do sample test questions. On the day of the test, you only want to study facts. That's the playbook. Okay. So give you some coaching there. I know you guys are still going to do what you want to do, but I'm going to try and give you some coaching here. So, okay. All right.
So my
Uh,
test is tomorrow. Do you recommend that I don't do any like practice tests and stuff in the morning?
no, I want you to do all your sample test questions today. Okay.
Okay.
How
I don't
much
have
of
the sample questions, but
are you registered with me?
no.
Oh, well, what man? What the hell, man? No, you might want to consider it. Okay, um, give it a shot. See how you do. All right. If perchance you don't pass, then reach out to me and we can get you set up with using my material, and then you'll realize, holy cow! If you had my material, that test would have been so much easier. But give it a shot. Okay. Who did you use for your pre-licensing?
Prelicensingtraining.com.
Okay. The
But I
material's
bought
good. I don't like
questions
your
from
questions.
PSI.
Okay. I don't like the PSI questions. They're not like your test. Um,
Really?
yeah, I try to encourage people not to spend money on those things because it's not worth it. You may get one question that looks like your test. Exam effects. Pre-licensing training has a couple good ones, but I got to be honest with you. I've seen pre-licensing training, and some of them their answers are wrong.
Yeah.
So I can't vouch for other companies' questions. I know the concepts are good, but what separates me from them is I actually gather as much information about the exam question to put it together to look exactly like what you're going to see.
Yeah, and you're in California too, so it makes it so much better.
Yeah, so give it a shot. If not, reach out to me. All right, and then we can set you up with access to my website. Okay.
Okay, how can I reach out to you?
Email me. Lauren, I'll put it in there. Lauren, Luren at lgdconsulting.com. There you go.
Okay, thank you so much.
Oh yeah, not a problem, not a problem. And if you guys have questions as you're studying, reach out. By the way, tomorrow I hop on a plane and I'm out of the state for a week. So yeah, just so you know, you'll have to email me next week. I'll be sitting on a beach in Maui somewhere.
Okay.
Um, yeah, probably can't reach over and pick up the phone because my hand's full with a drink. So no, I need a break. Yeah. So all right, all good, all good. All right, so let's jump into personal auto. So these are the parts of a personal auto policy. Coverage A, B, and C are liability coverages. Make sure you understand that. Okay. Even though coverage A is liability, A, B, and C are all liability coverages. So, and this gets tricky because when you take your test, I'm sorry, I should say, when you've been studying for this test, you're going to see under a personal auto policy this, under a personal auto policy that, under a PAP this, under a PAP that. Okay. And they'll ask you a question about some coverages. Okay. Then when you go take your actual exam, it says under an unendorsed personal auto policy, blah, 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 blah. Okay. Unendorsed means you just bought a personal auto policy. So don't think that there's some new coverage that you didn't study, all right? Because we only have the personal auto policy form. And it's the same pretty much in all states except for Texas and Maryland because they have no fault. Those are no fault states. They're a little bit different. Okay. But coverage A is liability. That's bodily injury and property damage to others. Coverage B is medical, which covers you and your family and your friends in your car that are injured in an accident you caused. All right. Under uninsured motorists, which is UM, or underinsured motorists, UIM, that covers you and your family and your friends in your car because you got hit by someone who doesn't have insurance and it's the other party's fault. So if someone else hits you and injures you, and either they don't have insurance or they don't have enough to take care of you. Okay, that's what that's about. Hold on. This is what happens to work from home with some teenagers. They're playing Mario Kart, so I apologize for the background noise. So okay, so yeah, so these are liability coverage. This you're paying other people because you hit them, you injure them, or you damage their property. Personal injury protection is what we call no fault coverage. And so here in California, we have split limits 15, 30, and 5. Those are the minimum liability limits. And I'm talking, so I'm doing this for a reason. 15, 30, and 5. You're learning this for the test. When you sit with a prospect, you don't talk like this. Okay, you're not going to say, "Hey, what are your liability limits?" All right. Oh, I notice on your deck page you've got 25, 50. Your customers have no idea what the hell you're talking about. Okay, so you're going to get split limits 15, 30, and 5. In California, those are the minimum liability limits that you need to have in order to drive your car on the California streets and roads. Okay, so let's start with the first number, 15. That's actually 15,000. And $15,000 is the maximum we pay for bodily injury for any one person in the other car that you hit and injured. Or it could have been a pedestrian. That's the maximum we're going to pay them for their medical bills and their lost wages. The second number is 30. That means we're paying no more than $15,000 for any one person, but we're not going to pay more than $30,000 for all the other people that are injured in that car from this accident you caused. Okay, so the first two numbers of the split limits cover the people in the other car that you hit and injured. The third number, 5, which is 5,000, covers damage to the car you hit. And it may not be a car. Maybe you hit a fire hydrant. All right, maybe you lost control and drove through someone's living room. All right, and so the liability covers the other people you hit. Remember, L for liability, L for lawsuit. All right, you injure someone else, you damage someone else's property, and they're going to sue you to pay for it. That's what that's about. So medical covers you and your passengers in your car. So if you hit them and injure them, well, what if you and the family members, your friends in your car are injured? Well, medical can help apply towards that. Now, medical covers injury in an accident that you cause, or you might see someone injured in and around the vehicle, or someone injured while alighting from a vehicle. Alighting from a vehicle. How's that? Okay. Nobody talks like that. And so basically that means you're stepping out of your car and you got injured. That's what injured while alighting from a vehicle. All right. So this crazy language that the test uses, because they went to town on the thesaurus, to where how can we word this to where people don't understand what we're talking about. God, these kids. All right. Coverage C is uninsured or underinsured, and we'll go with 1530. So if you have 15 and 30 for bodily injury under your liability, the uninsured or underinsured will probably be the same limits, 1530. Okay, so if we're going to hit someone else and pay them 15,000 for their injuries, then you probably want 15,000 for you and your family if you're injured. You see, so they should match. And there's only two limits or two numbers for uninsured motorists because it only covers the people. So if you got hit by someone who doesn't have insurance and they damage your car, uninsured motorist bodily injury doesn't pay for that. You need uninsured motorist property damage coverage. And if you only have the liability coverages, which is A, B, and C, the UMPD, uninsured motorist property damage, will pay a maximum of $3,500 to fix your car. Okay, that number is going to stand out on the test. So these three basically cover liability. So now coverage D covers your car. So physical damage to your car, either because there's damage to the car because of a collision claim or other than collision claim. Now, those of you in the real world, you're used to calling it comprehensive and collision. The test world calls it other than collision instead of comprehensive, but they still use collision. So collision is damage to your vehicle because you hit something and damaged your vehicle. So you drove into a tree and damaged your car. You hit another car which damaged your car and it was your fault. So when you hit another car with people in it, liability covers the people in the car in the other car, and then collision covers damage to your car because you caused it. That's how you need to understand that. The definition of collision is colliding with a vehicle or object in the road or upset. Now, when you hear upset, that means your car flips over. And you would be upset. Okay, so, and you hear stories of people falling asleep at the wheel and they roll off the embankment because they drove off the road. That's a collision claim. Right? Usually higher deductible, your rates are going to go up because it's your fault. Other than collision is damage to your vehicle from losses other than collision or upset. So if a tree falls on your car, that's an other than collision claim. The tree hit you. Right? Someone steals your car, that's an other than collision claim. Right? The most common other than collision claim, that windshield chip. Okay, now with other than collision, usually a lower deductible and your rates don't go up because it's not your fault. Most people don't realize that earthquake and flood are covered under your auto policy if you have other than collision coverage because it's not excluded. All right. So now if you hit an animal, we always say the animal hit you. So if you hit a deer in the road, as long as it was running, then it's an other than collision claim. We always say the animal hit you. Now, if the deer was already dead in the road, that's a collision claim because you hit a stationary object. Okay, so just so you know, and on the test, I don't know if they use a deer or a cow, but if you hit an animal, it's an other than collision claim. Okay, all right. Some additional items. Towing and roadside assistance. This covers labor conducted at the scene of a breakdown. Okay, what if it's standstill? Deer, you're talking about the deer, Dylan? If it's standstill, if it was alive, um, yeah, that's a good question. That's not on the test. If you hit a deer, it's just going to be other than collision. That's what you need to know. Okay, in the real world, it will depend on the claim situation. Okay, so like if it was already dead in the road. If it was standing still, you're supposed to not drive faster than it is safe. Hopefully, you should have stopped in time where you didn't hit the deer. But a lot of times, deer are running across the freeway, and so we always say the deer hit you. Okay, cool, cool, cool. All right. So towing and roadside assistance covers labor conducted at the scene of a breakdown or labor conducted at the place of disablement. That's just towing, we come up, the tow truck comes out, gives you a jump, fixes a flat, maybe give you 3 gallons of gas and send you on your merry way. Or if you cannot drive, it'll tow you to the nearest shop, and that's it. That's all it is. If your car is in the shop because of a covered accident, then you can get rental reimbursement. Now, for the test, the rental reimbursement coverage gives you $20 a day. Okay, so if you get into an accident, you got to wait 24 hours or 1 day before we pay you $20 a day for a rental car. Okay, that's for the test. If someone steals your car, you actually have to wait 48 hours before we pay you $20 a day for a rental car. Reason is, yeah, your car might show up, or you sober up and remember where you parked your car. That does happen, and I actually have some friends that have lived that story, so I got to laugh at that too. But yeah, theft of a vehicle, you got to wait 48 hours for us to pay the $20 a day for rental car. There's no such thing as motorcycle coverage. There's no such thing as a motorcycle policy. It is a personal auto policy with a miscellaneous type vehicle endorsement. And that endorsement says this auto policy is actually covering a motorcycle. So the endorsement isn't really an add-on to give you additional features. This particular endorsement is just defining what this policy is covering. And it may not be a motorcycle. It could be an ATV. It could be an RV. It could be a dune buggy. But all it is, it's an endorsement that's added to an auto policy that defines this auto policy is covering a dune buggy. Okay, and that's how you need to know it. Named non-owned auto coverage. If you ever see this, or as you're reading a question, you'll see someone lives in a city and they don't own a car, boom, that's named non-owned auto coverage. All right, so it's an individual that doesn't own a car. And so they're getting liability coverages, remember A, B, and C, in case they borrow their friend's car or they rent cars for long trips. So this is basically the liability portion of an auto policy for someone who doesn't own a car. Okay. Now, before I get into extended non-owned auto coverage, understand how your auto insurance works. If you have a vehicle, you have auto insurance, and you lend your car to your neighbor, because their car's in the shop, they needed to go to the store to get some groceries. If they get into an accident, your insurance is primary because it's your car. So if you lend your car to your neighbor, they get into an accident, your insurance is primary because it's your car. Your neighbor's insurance will be excess if yours isn't enough to cover the incident. Likewise, if you borrow your neighbor's car occasionally and you get into an accident while going to the store because your car's in the shop, your neighbor's insurance will be primary and yours will be secondary or excess. You see, insurance follows the vehicle. Anyone using your vehicle with your permission is covered by your insurance primarily. Okay, so if you borrow someone else's car, then their insurance will be primary. And so this is occasional use of a vehicle. But let's say you have a personal auto policy and you work for a company and they give you a company car to use for business, non-business purposes. That means that your policy, because it's not occasional use, actually excludes coverage for vehicles furnished for regular use. So if you're driving your company car around and you get into an accident, while you go in the grocery store, your policy won't pay on that. So you're thinking, well, wait a minute, it's a company car. They have insurance to cover me if I'm using their car. Well, yeah, but what if your company's cheap? They got like really low limits. So you hit someone and they're suing you for 200,000. Your company only got you $100,000 of liability. That means you're $100,000 short. Where's that 100,000 going to come from? Because I just said your personal auto policy excludes coverage for vehicles that are furnished for regular use. Right? That means it's going to come out of your assets. So if you add this endorsement to your policy, it will extend your coverage to a vehicle that you do not own, but you use regularly. And so it kind of lifts that restriction and covers you while using a company car. That's how you want to understand that. Your personal auto policy excludes coverage in Mexico. It excludes coverage in Europe and Africa and Asia. Your personal auto policy only covers you driving your vehicle anywhere in U.S. and Canada and U.S. territories. That's it. No coverage in Mexico. Keep that in mind. All right. But a different question says if someone purchases the limited Mexico coverage endorsement, it will provide coverage for what? And it's up to 25 miles into Mexico from the U.S. border for no more than 10 days. Now it's 25 miles from the U.S. border, not the Mexican border. Okay, so I want to emphasize that because that's kind of a tricky one on the test. And a lot of you are thinking, well, what's the difference? Well, there's a little zone in between those two. We call it DMZ, demilitarized zone. It's kind of a gap between the two countries. So, and so it's from the U.S. border to cover you during that gap. Okay. But otherwise, if you did not have this endorsement, there's absolutely no coverage in Mexico. So keep that in mind. All right. You gotta understand vehicles. Vehicles typically have three coverages. All right. So I mean, look at your auto insurance. It's primarily three coverages. There's liability in case you hit someone. There's medical for you and your passengers in your car in case they're injured, right? And then there's physical damage for your car. Okay, so that's your car. How about if you had a boat? Well, a boat's a vehicle too, right? So that means that if you have a boat, you need liability in case you hit something, medical for you and your passengers on your boat, and you want physical damage coverage for your boat in case something happens. Okay. That means if you have an airplane, small aircraft, and you get aircraft coverage, okay, the coverages would be liability in case you hit something with your plane, medical for you and your passengers on your plane, and you also want physical damage for your plane in case something happens. You see, all three of them are vehicles. One's on land, one's on water, one's in the air. But being vehicles, the coverages are the same. And so you're going to get questions like a boat owner's policy is similar in design to which of the following? It's the same as an auto policy. Okay. It's a vehicle. One's on land, one's on water. That's it. Okay. Does storage does storage also get covered under the coverage? Or would there need to be an endorsement? Storage for what? You're talking your boat? The storage fees? Yeah. I haven't seen that on the test. A trailer you might get, but not really the storage. Okay. The storage, now you're going to a whole nother world. If it's a layup, is it in an enclosed housing? Is it taken out of the water? Or is it left at the dock? And so there's a little more in the real world on that. But as far as a test, yeah, that's not really an issue there. Okay, so all right. Don't go too deep, Dylan. Take a step back. All right. In general, what are they asking? How does the coverage work? Okay. In the real world, we definitely take a deep dive, and you'll definitely have a better understanding on that. So, okay. So, yeah. So you're an analytical guy, which is good. Just on this test, take a step back. Okay. So, all right. Cool. All right. I like the engagement though. All right. So vehicles coverages are basically the same. All right. So now we're going to jump to a home policy. Homeowners has section 1 and section 2. Section 1 is property. Section 2 is liability. Okay. Section 1, we have the dwelling. Coverage A is a dwelling, which is a house. Anything bolted, welded, nailed, attached to this house would be coverage A. We have an attached garage. Okay. That's coverage A. Coverage B would be other structures, sometimes called separate structures. Okay, that's my girlfriend's daughter screaming. I can't believe they screamed that loud playing Mario Kart, guys. All right, so other structures would be, I don't know if you see this fence around the yard in the back over here, that would be other structure. It's another structure on the residence premises separate from the main structure. This garage, I mean, maybe it's a separate garage. There could be a clearing between the house and the garage, and so the garage would be separate structure, and that would be coverage B. All right. Coverage C is your personal property. That means everything you own. Flip the house upside down, anything that falls, that would be coverage C. Also called contents coverage. Coverage C, personal property under a homeowner's policy covers your personal property anywhere in the world. Anywhere in the world. How cool is that? So if you're vacationing in Ireland, right, you left your suitcase in the back seat as you go into a restaurant to get something to eat, someone breaks the window in the rental car and steals your suitcase, your luggage would be covered under this home policy that you bought here, okay? Because this is covered anywhere in the world. Now, coverage A and B are real property coverage. Real property means structures on the residence premises. Personal property or contents, of course, would be personal property or contents, which is easily movable. That means if you were to move, anything you're typically going to take with you is coverage C. Anything that you're going to leave behind, like that ceiling fan that you installed, is going to be left in the structure. Okay, and that would be rated as structure. So these are all, A, B, and C are direct loss coverage. That means direct physical loss, damage, or destruction to your property. All right. Coverage D is loss of use, and this is what we call indirect or consequential loss coverage. See, if your house burns down, you can't stay there. It's uninhabitable. Man, you need money to stay at a hotel till we rebuild your house and you can move back in. Well, guess what? That's what loss of use coverage is. It's indirect. Direct loss is damage to your property. Because of the direct loss, you can't live there. Now the indirect loss covers costs to put you up at a hotel. Okay. This is also true for like restaurants, businesses. You know, if a restaurant closes down, the direct loss is they lost their building, right? And they got to rebuild it. The indirect loss would be loss of business income. Because if they're not open for business, cooking food and making money, well, what's the owner going to do? Because they relied on that income to cover their bills. And so that would be business income, which is an indirect or sometimes called consequential loss coverage. That's how you need to know that. So you got to know the difference between direct and indirect. Theft is built in. There are some sublimits. If someone breaks in and steals all your jewelry, all you get is $1,500. That's called a sublimit. A sublimit is a limit on a certain type of loss within the overall policy maximum. Okay. So it's kind of like health insurance. You know, maybe you had a $6 million maximum lifetime benefit. And so in the sense in buying this policy, that the insurance company's opening up a savings account with $6 million in it for you to use towards your medical care. But out of that $6 million, you can only use $10,000 towards chiropractic care. So it's a limit on a certain type of loss within the overall policy maximum or limit. That's called an inside limit. Okay. So your high theft items have sublimits. All right. So section 2 is liability. That covers you and your family members anywhere in the world. So if you have a cocktail party in the house, someone slips and falls and they got injured, well, medical will cover the ambulance ride. Okay. And then because they're in the hospital racking up medical bills and unable to work, that's the liability portion. And this covers you also. Section 2 liability of your home policy covers you and your family members anywhere in the world. So if you go to southern Italy, you're on a golf course and you shank a ball and hit some guy in the head, this homeowner's policy, the liability section, would cover that injury even if it's in another country. Your homeowner's Section 2 liability covers you anywhere in the world except, number one, when you're in your car. Because now we're going back to your auto liability because you injured someone else in your car. And it doesn't cover you at work because that would be your employer's general liability because you as an employee injure a customer. Remember, liability is the other people, not you. Okay, so liability at work doesn't cover you because you're under workers' comp. You're a first party, you're an insured. It's the customer or the third party that's injured. That's going to be the liability portion at work. And your home policy doesn't cover that. Okay. If you do have collectibles, we can get floaters. We have a personal property floater, which gives you higher limits on personal property on an unscheduled basis. All right. So remember, the maximum we give you for theft of jewelry under a home policy is $1,500. So if your jewelry is worth more than that, but you don't have any unique high ticket items, you just got a lot of little stuff that exceeds the $1,500. And so you get a personal property floater, which just gives you a general increase over all your jewelry, and it's unscheduled, so we don't need appraisals. Or if you have some really high ticket items, then you get a personal article floater. Now, whenever you see the word scheduled, it means I need a list. I need appraisals. That means we need to see appraisals in order for us to insure it at the value that it's worth. Right? The cool thing about floaters, it covers your personal property anywhere in the world on an all risk basis. Okay, so worldwide coverage, all risk basis. Remember, all risk, pay attention to exclusions. If it's not on the exclusion list, it's covered. By the way, your common exclusions are the catastrophic losses, earthquake, flood, nuclear risk, war, right? And the ones that nobody wants to cover, which is wear and tear and intentional acts. Intentional acts are not covered by insurance, okay? Personal effects floater is what this last one is. This is a very rare question. You know, you got these people backpacking in Europe, and anything they carry on them, personal effects. That means if someone steals their camera, their traveler's checks, their passports, they can get that coverage under a personal effects floater. All right. The reason you want to get this if you travel a lot is because this pays a claim and it doesn't increase the rates on your homeowner's premium. Okay. So, and that's how you want to understand that. All right. Repeat these three coverages. Yes, these are endorsements added to a homeowner's policy or dwelling policy. So a personal property floater is increasing limits in general. You know, maybe, like I said, you have more jewelry than $1,500 that your homeowner's policy will cover you for, but you don't have a lot. You don't have any, I guess there's no really one high ticket item. You just got a lot of little stuff that exceed $1,500, but overall, maybe no more than 10,000. The personal article floater, I need a schedule with appraisals because that would be like you've got a 6 carat stone ring. Okay, and we need an appraisal for that because that's more than that personal property float at $10,000 scheduled limit, unscheduled limit, I should say. And so that we need to schedule at a higher amount. And with the appraisal, it gives us more of a clear description of what it is we're insuring. Okay. And personal effects is just stuff you take with you when you're traveling. This one's a very rare question. Okay. Most likely it's going to be one of these two. Scheduled means I need a list with appraisals. Unscheduled means no list. But you do have to prove you had it if a loss occurs. Don't get me wrong. Okay. And by the way, you can pretty much buy a floater on all of your belongings except cash. The maximum we pay for cash is $200. Because come on, anyone can say they had $80,000 in their mattress when the house burned down because they live in brushfire country, you see. And so that increases the likelihood of fraud. And so insurance companies have these sublimits where it doesn't matter what happened. We pay up to this limit unless you paid more for additional coverage. And you can get additional coverage for jewelry, firearms, silverware, as you can see, sports cards, collectibles, but you cannot increase the limits for cash, okay, or money. $200 is the limit. That's a test world, by the way. Real world companies do have some. I've seen up to $400,
So
which
it's
is not.
called scheduled.
Yeah,
It's
schedule
called
means I
scheduled
need an
because
itemized.
it needs a list and that item is specifically scheduled down.
Yes,
Whereas
that's
the
exactly.
personal property floater doesn't really have to necessarily have something exactly scheduled.
Yeah, exactly.
Okay, perfect,
Okay,
thanks.
you got it. All right. All right. Cool. 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 All right. So homeowners, in order to buy a homeowner's policy, it's got to be owner occupied. You own it, you live there. When you hear dwelling coverage for this test or dwelling policy, you own a house, but you don't live there. All right, you're renting it out to other people. That means you're a landlord. And so for the test dwelling, you're a landlord. You own a house and people rent from you. And so you, as an owner of the building, you need coverage for the dwelling. All right, that's covers the house itself. There may be other structures like the fence. And this is yours. You own this stuff. Personal property, you don't need as much. I mean, if you own a home, you rent it out, you don't keep a lot of stuff there. And so you can kind of reduce that coverage to a minimal. Maybe it's just the built-in appliances, right, that you furnish the house with, the washer, the dryer, the refrigerator, the stove. But I mean, a lot of times, if you're in good people, hopefully nothing happens to that. They don't damage it or steal it. Okay. But again, that's kind of what dwelling coverage is about. These are, again, the direct loss coverages, A, B, and C, which is just like home. Home, coverage A is dwelling, coverage B is other structures, coverage C is personal property. Um, for home, we only have coverage D called loss of use. But I got to be honest with you, if I take coverage D and E and I combine it, it's the same thing as loss of use. So coverage D is loss rent. So if you're a landlord and this place burns down that you're renting, that means your tenants can't live there. It's what's called untenantable. Your renters are going to go live someplace else. Well, if they're living someplace else, they're not going to pay you rent. But again, as a landlord, you relied on that rent to generate income to cover your bills. And so due to a covered loss, we can pay loss rents. Okay. Minus discontinued expenses. Now, when I say discontinued expenses, means we'll pay you lost rents because of this situation, but we won't cover utilities because there's nobody using the gas, electricity there. You see what I mean? And your renters would have to pay for gas, electricity wherever they go. All right. So we're not going to cover that as far as lost rents. But let's say you live there. All right. So let's say you have a threeplex. You live in one unit, you rent out the other two. And so if coverage D covers a lost rents from the other two units because the place burned down and the renters aren't paying you rent, what if you live there and it burns down? Where are you going to stay? Well, that's what additional living expense is about. Again, it's like the loss of use portion. It covers the cost of putting you up at a hotel till we rebuild this property so you can move back in. Okay. These two are indirect loss coverages. These are direct loss coverages. So it's really the same as a homeowner's, but homeowners has 4 parts in their property and dwelling has 5. Why they separated this out, I don't know. But it's basically the same thing. It's just 5 parts instead of the 4 for a home policy. Okay. Dwelling is only property. So you could almost call this a monoline policy. It's property only. Homeowners is a package because it covers property, theft, and liability. Okay. So if it's only one line, it's a monoline. 2 or more is more of a package or combo policy. You could get theft and liability as add-ons to your dwelling policy. All right, so whereas homeowners is that combination plate, it's got the property theft and liability built in, and it's cheaper when you package it up, like going to a restaurant and getting the combo. Dwelling is just the property. And by the way, would you like to add theft and liability? Because it's additional charge, but we can add it on. Well, buying the package home is cheaper than buying a property and then adding this and paying more to add this too. You see, but that's basically how it works. As far as theft coverage, we have limited theft or broad theft. If it's owner occupied, you can get broad theft, which is a little more liberal. And if you don't live there, you rent out the property, then you can only get limited theft. Okay. Liability is the same as liability under a home policy. Comprehensive personal liability is what it's called. Instead of saying comprehensive personal liability, you'll just see these abbreviations, CPL. So this is personal liability, which covers you and your family members anywhere in the world, just like your home policy. Okay. So again, if you take home and you portion it off into 3 parts, property, theft, and liability, well, then you have dwelling. But if it's all packaged up and it's a cheaper rate, that's your home policy. Now you buy a homeowner's policy instead of dwelling because you own it and you live there and you want broader coverages. You would buy dwelling instead of homeowners because you don't live there. Okay. So again, whenever you see dwelling for the exam, it's your landlord. Okay. Now, homeowners is 1 to 2 family living units. So a single family home that you live in, or a duplex where you live in one unit, you rent out the other. You can get a homeowner's policy for that because it's up to 2 living units. If it's not owner occupied or it's more than 2 units, then you go to dwelling. Dwelling is 1 to 4 units, right? That may or may not be owner occupied. So if it's a 3-unit structure where you live in one unit and you rent out the other 2, you can't get a homeowner's policy, even though you live there, because it's 3 units. Homeowners is only 1 to 2. Okay. And so there's some, in going through the questions, you'll kind of pick that up as far as the differences between the coverages. All right. So if it's more than 4 units, because dwelling is 1 to 4 units, if it's more than 4 units, now we're going to a business owner policy. And a business owner policy is kind of a package like a home policy. It covers property and liability. Now, theft is optional. See, as a small business, maybe you run an accounting service, you just need a little office, you got your little, your desktop or laptop that you basically do taxes and everything stored in the cloud. You may not need theft coverage. Someone breaks in and steals your laptop, that's all they got is a laptop. Okay, all your data is stored in the cloud in a secure location. And all you got to do is just go buy a cheap laptop. As long as you get online, you can access the cloud and continue to do business. And so you can choose not to get theft coverage for a small business owner. If you do want it, we can add it. Another thing for business owner policies, we have something called boiler and machinery. Every once in a while, you hear it called equipment breakdown coverage. And so let's say you've got a small sandwich shop. All right, now with the sandwich shop, you probably got refrigeration equipment, right, to keep the food fresh. So what happens if it's damaged and it's not cooling? Your food can spoil. And so boiler machinery covers things like that. The mechanical breakdown associated with machinery. A lot of times you'll see steam pipes, steam turbines, generators, and things like that, because that can also be covered under this. But it's more systems. Most of your premium for boiler machinery coverage actually goes towards inspections to prevent loss. Replace some worn out fittings to keep from a catastrophic explosion from occurring. Okay, that's what that's about. It's all risk coverage, replacement cost, but that's what it is. Now, if you bought a house, I mean, some of you may have bought a house. When you bought the house, they offered you that home warranty, and the home warranty covers your appliances. Something breaks down, you pay a deductible, some person comes out there and fixes it. Well, think of boiler machinery as the same thing as a home warranty, but for a business. Right? I mean, something happens, pay a deductible, someone comes out and fixes your machinery. That's it. Okay. But again, most of the premium goes towards inspections on this, and it's optional under a BOP. So we're kind of setting it up where homeowners is 1 to 2 units, owner occupied. Dwelling is 1 to 4 units, typically non-owner occupied. More than 4 units, a business owner policy actually covers up to 6 stories, up to 100,000 square feet, and up to 3 million in annual sales. Okay? Then you can cover it under a business owner policy. If it's larger than 6 stories, larger than 100,000 square feet, you do more than 3 million a year, or it's too specialized, the next step is going to a commercial package policy. Okay. Now, I call it a commercial package policy. A lot of your study materials call it a commercial package policy. The test will call it a modular policy a lot. All right. So a modular package, or a modular policy, I should say. And so instead of calling these coverage parts on your exam, they call them modules. Again, your test just went a little crazy with the thesaurus. That's all. Just change the verbiage. Now, a commercial auto, this could actually be written as a monoline policy, like an auto repair shop. You can just get the commercial auto policy to cover the repair shop. So that's just one line. But if you get two or more, like this building is more than 6 stories, right? Then you want property. You want theft coverage. Now in commercial, instead of calling it theft coverage, we call it crime coverage. Same thing. Okay. Someone could steal your stuff. Liability, right? Someone could slip and fall. Or someone could buy your product, take it home a couple of years later, and malfunctions and injures them. That's the liability. Boiler machinery, maybe they have some generators, right? Steam pipes, steam turbines. Inland marine is the same as a personal property floater, a personal article floater. It's covering high theft, high ticket items. And it's funny, it's called floaters or marine coverage, even though it has nothing to do with boats. And we're not covering stuff that, in a sense, floats. Because good jewelry typically doesn't float, does it? But it's covered under jewelry floater. Okay, it's just old maritime law terminology that we just use today still. Okay, so it's called floaters on the personal lines, called inland marine on the commercial side for the test. Okay, and of course, auto. You got an auto at home. We got a bunch of vehicles we give our executives at work. Okay, and so these are your commercial package coverages. And then we have farm listed here, but farm is kind of its own element. Not only do you live on the farm, you also work there. Okay, so it's kind of a blend of residential and commercial on one plan. That's how you want to understand that. Okay, so looking at the different parts or modules, the first one is going to be property, and that covers a building. Well, yeah, this is more than 6 stories high, so you can't cover it under a business owner policy. So it's going to the property coverage covers the building, covers your stuff. That means this is going to cover your desk, right? Your computer, your personal belongings. Actually, I say your commercial personal property, business personal property, and can also cover personal property of others. Okay, so let's say one of your shops, you have a veterinary hospital where people leave their pets overnight. Okay, and that's what we call bay lease coverage, but it can cover personal property of others. That's how you want to know that. Everything on your commercial property policy is actual cash value basis. So your homeowner's policy, we're going to give you a replacement cost to your home and an actual cash value for your belongings. So replacement cost means to replace your home brand new. Actual cash value is giving you used value for your belongings, like your TV and your clothes. For a business, we give you actual cash value for the building, actual cash value for your stuff, and actual cash value for other people's stuff under your care. So if it's a dry cleaner that burns up, right? So the building got destroyed, right? All your dry cleaning equipment got destroyed, and the customer's property, right? The clothes that they left for you to dry clean got destroyed. And that's what this policy is about. Okay. For crime coverage, coverage A is if your employees do something wrong. Now, typically, your test, it does throw a little kinks in the system, and it's kind of funny how they do it. All right. So, employee dishonesty would be covered by which of the following? Now, I got to be honest with you. When you hear employee dishonesty, I want you to think of a fidelity bond. Because a fidelity bond basically is you as an employer, you're buying a fidelity bond to protect you in case your employee steals from you. Okay. So it's a bond, it's not insurance. And so when you hear that or you see that test question, employee dishonesty, but would be covered by which of the following, I want you to look first and foremost for fidelity bond. If you don't see fidelity bond, then the next best guess would be commercial crime coverage. Okay, because coverage A, the employee dishonesty coverage, is actually a fidelity bond within the commercial crime policy. And it just covers you if your employees are dishonest, they steal from you. Okay. Coverage B, C, and D is negative stuff to your company from outside parties. So some outside party broke into your company, took your company checks, forged, altered them, and sent them out to other people. Right? That's what coverage B would be from outside parties. Because if your employees stole your company checks, that would have been covered under employee dishonesty. Theft of money and securities is theft of money and securities from outside parties. Because if your employees stole your money and securities, that would be employee dishonesty. Coverage D is theft of property, like inventory, from outside parties. Right? Because if your employee stole from you or stealing your inventory, that would be coverage A, employee dishonesty. Okay. And so that's how you want to understand. So coverage A is your employee did something against you, wrong against you. Coverage B and C and D are outside parties. All right. Commercial general liability. Now you might see commercial general liability. You might see CGL. You might see general liability, or you just might see GL. I have 4 ways of saying the same thing, but it's liability associated with a business. Your commercial general liability policy has 2 sublines. In the real world, they have 6, but for the test, you only need to know 2 sublines. The first subline is premises and operations. That means liability losses that occur on the premises, in the location or in and around the building within 100 feet of the premises, like a slip and fall. That would be one subline. Premises and operations, that's what it's called. Well, let's say you manufacture a product, someone takes it home, 2 years later malfunctions and injures them. That loss occurred away from the location of the business. So that would be the other subline called products and completed operations. Right? So premises and operations covers liability exposures in and around the building, and products completed operations covers losses away from the location of the business. Okay, so they're two separate sublines. Now, that means your commercial general liability has two separate aggregate limits. So we need to back that up a little bit. If you have a homeowner's policy and if you have $100,000 of liability coverage, that's going to be a per occurrence limit. That means for any liability exposure, your policy will pay up to $100,000 for this particular loss, and that's it. Okay, that's per occurrence. But your policy has an aggregate limit. We'll say 200,000. So you have a per occurrence limit of 100,000, but you have an aggregate limit of 200,000. Now, the aggregate limit is defined as the maximum your policy will pay for all claims during a policy period. So you can basically suffer two full $100,000 liability claims during that policy period. If a third one comes in, then you're going to have to self-insure because you exhausted your insurance. Okay, once the insurance company pays out the aggregate limit, there's no more insurance for that policy period. Okay, you exhausted the policy limit. Now, all of your policies only have one aggregate limit, except for this one. Your commercial general liability policy has two separate aggregate limits. One for losses that occur in and around the building, which is the premises and operations, and the other aggregate limit is for products and completed operations for losses that occur away from the location of the business. Okay, so make sure you keep them separate. If you do look at the deck page, it typically just lists the premises and operations limit. It doesn't really list the products and completed operations aggregate limit. Okay, so but as bodily injury and property damage to others, that means if you're injured, you're an employee, you're covered under workers' comp. You're not covered under the general liability policy. Personal and advertising injury. Let's say you have a company and you do a marketing campaign, advertising campaign, and you knock your competition. Well, they lose money because of it, and so they sue you. Where would this be covered? And you need to know, right? So since it's an advertising thing, it's going to be covered under Part B of your commercial general liability policy. Right? So yeah, you do need to memorize parts, and that's what makes this test tougher than most other exams. Is you have to memorize parts. You got to pay attention to detail. Okay, just not too much detail, Dylan. Okay, all right. So, all right. So, and yeah, that could be a test question. All right. So, yeah, we have an advertising campaign, knocks our competition, they sue us. Where would this be covered? You want to look for Part B of the CGL, personal advertising injury. If you don't see Part B, take a step back and just pick commercial general liability coverage. Okay, remember, look for specific. If you don't see it, take a step back and go with the general. All right, it's a specific part of the CGL. If you don't see it, then it's just pick commercial general liability. Medical payments to others also associated with your commercial general liability policy. Like I said, it typically covers the ambulance ride. Right? And once they're in the hospital, racking up medical bills and lost wages, that's the liability portion. Right? Another thing I want to jump in every one of your liability policies, there's another section of that policy called supplementary payments that people typically don't see. Always, always remember, when you buy liability coverage, you're not only buying the liability limits that we see here on this policy, you're also purchasing the insurance company's legal defense team to possibly defend you in cases against you. So if the insurance company chooses to defend you, the insurance company covers the legal cost to defend cases against you. How's that? And it doesn't reduce your liability limits. So if you have $1 million of liability coverage, someone's suing you for $1 million, and the insurance company is choosing to defend you, and it costs $400,000 to defend you, and they lose. That means not only did the insurance company have to pay the $1 million policy limit, they also had to cover the $400,000 in legal defense costs, even though you had a $1 million limit. Okay, so that's called supplementary payments, and it pays above and beyond your liability coverage. Okay, most people don't realize that. All right. The other coverage parts of modules, boiler, machinery, equipment breakdown coverage, and I'm just using this picture of refrigeration equipment. In case something happens, we have spoilage. All right, so it's going to cover replacing this equipment or fixing it on a replacement cost basis. It's all risk coverage. And like I said before, most of your premium goes towards inspections to prevent loss. kind of that mindset, an ounce of prevention is worth more than a pound of cure. So by doing routine inspections, right, maybe we can detect something in the system, fix it to keep from having a major loss. And it is more of a proactive approach. That's how you need to understand boiler machinery or equipment breakdown coverage. Now, since it's all risk coverage, whenever you see all risk, pay attention to the exclusions. Right? So you got to look at the exclusions list. If it's not on the exclusion list, it's covered. Wear and tear, I said, is not covered by insurance. Right? Things have a tendency to wear out, need to be replaced. The test goes crazy with the thesaurus, and they don't say wear and tear. Regarding equipment breakdown coverage, they call it inherent defect. Tools wear out and have to be replaced periodically. This is an example of an inherent defect. Okay, that's the exam way of saying wear and tear, okay, for boiler machinery coverage, and wear and tear is not covered. Okay, so in ocean marine, it's called inherent vice. Okay, something that has a tendency to self-destruct. I would say like my relationships. So no, so you know, let's say we're transporting a boatload of bananas from Brazil to the Bay Area. Okay, I'm in San Francisco Bay Area, so we're transporting a boatload of bananas from Brazil to the Bay Area. There's a huge storm off the coast. The boat can't leave the dock. When it finally is able to leave the dock, it still has to reroute around the storm. And by the time that ship lands in the Bay Area, they open up the crates, the bananas have spoiled. Okay, this would not be covered because that's an inherent vice. That's the ocean marine way of saying wear and tear, and that's not covered by insurance. All right. So, like I said, your test just goes crazy with the thesaurus. I mean, to me, it's creative. All right. For you guys, you're like, oh, son of a gun, man, why do they make it so difficult? Well, I look at it, it's a bit of a weed out process, you know, because if anyone just passed this test, everyone would be selling insurance. Okay. And yeah, some people probably shouldn't. Okay.
I
So
had a
it is
question
what it is.
really quick.
Yeah.
So, you were saying wear and tear is never covered by insurance, right?
Yep.
And what would be it? So that like banana reference you made, that was an example?
Yep. Our mechanical breakdown. Let's say your car breaks down. That's a mechanical breakdown, right? That's not covered by insurance. Right? Our insurance covers you if you get into an accident. It was sudden and accidental. Then it could be covered. But wear and tear, you know, your engine failed because it's just old. Yeah, that's not going to be covered.
Okay.
Okay. Yeah. Make sense?
Yes.
Yeah. Good. Ah, did
Thank
my
you.
job. I can go home now. All right. No. All right. I got to have fun too, you know. So, all right. I love this industry, folks. I'll never leave it. I can tell you stories as to why, and the hook as to why I'm here, and will continuously be here. So, but I mean, it's a great industry. Not for everybody, but if you apply yourself um, and quit from sitting on a fence and engage, you could really have a great living and great lifestyle in this industry. So. All right, I'll get off my soapbox. All right. Inland marine. Now we call them floaters on the personal line side. Remember covering your expensive jewelry that you have? Well, for business, we got a jewelry store. They have a commercial property policy which covers displays and your normal amounts of regular jewelry. But if this jewelry store has high ticket items, well, then again, we need inland marine coverage. Okay. Um, Inland marine covers the three C's: care, custody, and control of other people's property. So with a jewelry store, right, some people leave their jewelry here to be cleaned, maybe resized, refitted, maybe trading in for a larger stone. And then they leave, they come back 2 weeks later, and the jewelry store has burnt down with their jewelry in it. And so, again, this jewelry store has inland marine coverage because they have care, custody, and control of other people's property. Since it's inland marine, just like your floaters, it's all risk coverage, worldwide coverage. Instead of saying scheduled, you might see filed. But I got to be honest with you, we use scheduled and unscheduled on the personal line side. And for the test, they actually use scheduled and unscheduled on the commercial side too. So anytime you see scheduled, it means we need a list. Okay. We need an itemized list with appraisals. And that's how you need to understand that. Um, I'm using a jewelry store. I mean, theatrical property. Maybe we have like a play, okay, where we have scenery, props, costumes, costume jewelry. That would be covered under theatrical property coverage, which is a type of inland marine coverage. Valuable papers and records coverage covers valuable papers and records, okay, manuscripts, maps, drawings, and mortgages. Some of your questions are so straightforward you're going to want to talk yourself out of it because you're thinking it can't be that easy. Okay. One of them specifically I remember is the marketing and sales division of an insurance company is responsible for which of the following. And A says marketing and selling insurance products, which is what it is. And you're like, nah, nah, it can't be that easy. And then you want to pick one of the other answers, which definitely get it wrong. And people talk themselves out of the right answer. Okay. A lot of times the answer to the question is actually in the question. You just got to be open to it uh, um, and see it when it's there. Okay. So beware of things like that. Okay. All right. For commercial auto, now we cover a couple things in commercial auto. Number one, people in the automobile business, like dealerships, repair shops, but also we're using vehicles in the course of the business, like a company with a fleet of, in this case, trucks or vehicles. And so you hear commercial auto coverage, or you'll hear business auto coverage. Now, you might even see business auto policy. Okay. But just like your personal auto, we have liability coverage. There's medical and uninsured motorists. Now, the difference between commercial auto and personal auto in this area is a personal auto policy includes liability, medical, and the UM/UIM coverage. It's built in. I mean, they can sign off they don't want uninsured motorists. They can sign off they don't want medical. So, okay, but I mean, it's part of the program. They can sign off they don't want it. Okay, commercial auto is liability only. Medical and uninsured motorists aren't built in. You have to offer it in order to be added to the policy. The reason is if the only people driving these vehicles are your employees and they're only using the vehicles during work, if there's an accident where someone without insurance hits them and your employee is injured, they're covered under workers' comp. And so the medical and uninsured motorists really don't need to be on your policy. Okay. If you do have company cars and you do have your employees taking them with them, then you might want to definitely add that up. Okay. Because now that's non-business use of the vehicle and you want to protect your employees that are using the vehicles. Okay. For physical damage, we have collision and they actually use comprehensive coverage instead of other than collision, like on the personal line side. And so collision, we know damage to the vehicle due to collision or upset. And comprehensive is damage to your vehicle from losses other than collision or upset. But if you really want to go the cheap route, you can get what's called a specified cause of loss coverage. It's kind of a comprehensive policy that only lists named perils. There's like 8 perils, like lightning, fire, explosion, and that's it. So if something happens and it's not one of those 8 perils, it's not covered. So it's a very limited one. And you can mix and match it. You can go collision and comprehensive, or you can go collision and specified cause of loss. You can just get comprehensive, or you can just get the specified cause of loss, whatever caters to your situation. Specified cause of loss only, very inexpensive because it's so limited. The policy is less likely to pay. Okay. Farm coverage, we already talked about, kind of blend a residential and commercial on one plan. And even though your online training gives you a whole chapter and, like 12 questions on farm, you're lucky to get 2 farm questions on this exam. All right. Number one, you got to know it's residential and commercial on one policy. It can cover Farmer John's tractor as farm equipment. But it doesn't cover Farmer John's pickup truck that he drives to the store for groceries because that would be an auto policy, not farm policy. Okay. And that's kind of what that's about. There's liability associated with the farm, liability associated with the home. Okay. But that's basically that. All right. Ocean Marine, get this down. Maybe 3 questions on Ocean Marine. Hull covers the ship itself. As you can see, anything bolted, welded, nailed, attached to this ship would be covered under cover J. That includes the engine, the motor, the rotors, right? The rudders, I should say, and gasoline. Gasoline to move this ship is covered under the ship coverage, the whole coverage. Even if the gasoline is still in a can, it's meant to be in the engine, which is part of the ship. Cargo coverage covers these crates that you're transporting. Freight coverage reimbursing the shipping cost that you paid to have these crates covered. So freight coverage is kind of like reimbursing a stamp because you're paying someone to transport this cargo. So not only are if they lose the cargo, not only did you lose the cargo, you lost the money you paid to have the cargo sent. Well, guess what? Freight reimburses those shipping charges. And that's how you want to know that. Okay. Instead of liability, they call it protection and indemnity, P&I. It covers liability, and it could be added to the ship because the ship could hit something, the hull, right? It could be added to the cargo because the cargo could topple and damage and injure someone, and probably kill them with the weight. But it also includes medical and sometimes workers' comp for the captain and crew of the ship. All right. And so that's protection and indemnity. Medical for maybe it's a cruise ship. Okay. And so it could cover medical for the passengers and the captain and crew. All right.
So
And
you
so
said
these are your
whole.
four shipping covers. Yes.
So you said whole was for like anything that would happen to the actual boat, like engines and stuff?
Yep, including the
Okay.
gasoline or fuel. I think they say fuel on the test. Okay. Yeah. Okay. Pretty simple, huh? Kind of like auto insurance, right? This covers the car.
Yeah.
Well, the cargo would be covered under your home policy, right? If you left a laptop in the back seat and someone stole it, right? That'd be your homeowner's policy. Protection indemnity would be the liability associated with this ship.
Yeah, I wish I would have found your videos sooner because they're just so helpful to me.
Oh, thank you, thank you. Oh man, yeah, I got a lot. If you're registered, man, I got tons of videos too. Oh my god. I'm gonna redo some of them because I gotta get rid of that intro part. I gotta edit them. So all right, let's go on. Thank you, thank you. All right, bonds. Remember that bonds are not insurance. Bonds are actually financial guarantees. You're gonna get two typically on this test. I mean, there's all kinds of bonds: judicial bonds, faithful performance bonds, bail bonds. I mean, there's all kinds. But you kind of really need to know these two. So fidelity bond. Remember, you're an employer and you want to put something in place that protects you in case one of your employees steals from you. Right? See, the thing is, if you don't have anything in place, if your employee steals from you, well, number one, you're going to terminate them, right? Because you can't keep them around, right? But then you got to miss work because you have to now sue them to recover what they stole from you. So now, not only do you lost money because they stole from you, now you're losing more money because you got to miss work to deal with this, so your business can suffer. So what we can do is why don't we set you up with a fidelity bond? So you're the obligee, right? And anytime on a bond, the obligee is the one being protected by the bond. So you're buying a bond, protect yourself in case your employee steals from you. So you're buying a bond from the insurance company called the guarantor. So you're going to pay premium to the insurance company. Now your employee is the principal, and the principal has to they have to do something, or as the test will say, they have to fulfill an obligation. You know what your employees have to do? They have to simply not steal from you. Okay? So if your employee steals from you, you're going to terminate them, right? And then you file a claim against the insurance company. The insurance company is going to pay you what you're legally entitled to, basically what the employee stole from you, right? And then you go on about your life. And then the insurance company, since we paid you, we now go after the dishonest ex-employee to recover what they stole from you. There should never be a loss to bonds because whatever we pay you, we're going to get back from that dishonest ex-employee. Okay. But the great thing about bonds is rather than you trying to sue this employee and get your money back, we, the insurance company, we pay you so you can go on with your business and then we deal with it. Right? So bonds are basically a subrogation contract. You probably get two questions on subrogation: transferring your claim rights to a third party. Or a one-word definition for subrogation would be which of the following? And you're looking for substitution. Okay, so we pay you what you're legally entitled to, we take over the claim, and we deal with it. That's basically how that works. It can happen in all of your policies, like your homeowner's policy.
Can
Someone
you say
without
that
it,
again, please? Sorry, I'm
yeah.
trying to write it down. The
Oh,
subrogation and the substitution.
yeah. So if you see like a one-word definition for subrogation, look for substitution. All right. Another one would be transferring the claim rights to a third party. Okay. With your homeowner's policy, it's kind of in your home policy too. There is subrogation. So again, let's say someone without insurance loses control and drives through your living room. Uh, I just said they don't have insurance. So they have no insurance to pay for the damage they did to your living room. And you can sue this driver of this vehicle because clearly their car is parked right there in your living room. It's easy to prove that it's them. And you're going to win the court case, but they don't have insurance and they have a part-time job at a fast food establishment. So they're not really making a lot of money. So when you sue them based on their income, the judge says, well, they can only afford to pay you $50 a month until the debt's paid. Okay, well, $50 a month, that's several months and years till you finally get enough money to put a deposit on a contractor to rebuild your house. Now, the great thing about that is you have a homeowner's policy. One of the perils that's listed in your homeowner's policy is vehicles. A vehicle damaged your house. Pay your deductible. The insurance company covers the cost to rebuild your house, so you go on with your life. Then the insurance company takes over the claim and deals with that uninsured motorist that drove through your living room. Okay, so that's what it is. Rather than you dealing with it, you have insurance. We pay you so you can move on, and then we, the insurance company, deal with the person responsible for it. Okay, so that's so going back. This is a fidelity bond. Think of employee dishonesty. Another type of bond is a surety bond. And so you're a homeowner and you need these guys to build this deck in your backyard in time for your end of summer party. Okay. And so the contractor says, hey, I can build that deck in time for your party. And you emphasize, no, no, no. This has to be completed by the end of summer for my party. The contractor says, I promise I can build that deck by the end of summer for your party. Well, how can you guarantee the work? The contractor says, I will buy a surety bond. So now the contractor is paying the premium on a surety bond to guarantee the work that they're going to do. So remember, the principal has to do something. They have to build that deck in your backyard in time for your party. The bond that they're buying is protecting you because if they don't build the deck in time, the insurance company gives you the money to hire someone else to complete the work. All right? The difference between a fidelity bond and a surety bond is who pays the premium. In a fidelity bond, you, the employer, you're paying the premium to protect yourself in case your employee steals. In a surety bond, it's the contractor paying the premium to guarantee the work for you. Okay, but in either case, the obligee is the one covered by the bond, and in either case, the principal has to do something. They have to not steal, or they have to build that deck in time. Okay. Now, if a bond terminates or expires, you still have 1 year to file a claim. That means if something happened during the time that this bond was in effect, and then you just at the end of a year you just drop the bond, even after the bond coverage ends, you still have up to 1 year to file a claim to have that bond cover it. And so it's not that whenever you hear discovery period, it's kind of like extended reporting periods in liability coverage. It doesn't extend coverage. It just gives you more time to file a claim for something that happened when that policy was in effect. Okay, that's what a discovery period is on a bond. Because if your employee stole from you, it may take you a while to realize they stole from you. Okay, well, if that happens, you have up to 1 year to still file that claim. Okay, that's how that works. Right. All right, so I think there's only one person not registered. If you do not pass tomorrow, all right, then reach out to me. Here's where you can go and register, or just reach out to me, Lauren at lgdconsulting.com, and we'll talk about that. So, but whether you pass or fail, I hope you check in with me and let me know how it went, and
I
how I
will.
can better what I do. Okay, so
Thank
lots
you
in a
so
short
much.
period of time. Yeah, yeah, yeah. So I'm gonna leave it open. Any questions?
So, for the retractive date, that's the date where the policy became active, right?
Yeah, it's the earliest date that the policy will cover a loss.
Okay.
Okay, that's how you want to know that.
And for occurrence made claims and claims made,
Uh-huh.
um, do they both have, so the discovery period, you know how there's a 60 days?
Not a discovery period, extended reporting period.
Okay,
Okay,
extended reporting period.
give me just a second. Let me pull up one of my cheat sheets here. All right. So this if you have access to my site, you'll get this. Right? If you're smart, you'll just take a screenshot. No. All right. So this is I like this sheet, but yeah, it does take some getting used to. So on the left side, we have your general commercial general liability coverage. Okay. And there's two ways of writing commercial general liability: occurrence made, claims made. On the right side, you have commercial crime coverage, and there's two ways of writing commercial crime coverage: loss sustained and discovery form. Right? So you're going to get a question, and these four are going to be your answers: occurrence made, claims made, loss sustained, and discovery form. Okay, so if you see liability, bodily injury, property damage in the question, they're talking liability. That means your answer is between these two. I can eliminate 50% of my answers because this is how we write crime. This is how we write liability. Does that make sense? Okay.
Yeah.
If I see burglary, crime, or theft in the question, now my answer is between these two, loss sustained and discovery form, because that's how we write crime coverage. I can eliminate these two answers. So now I'm down to a 50-50 chance of getting that question right, huh? All right. That helps. Now, if I see a retroactive date or extended reporting period, now my answer is between claims made or discovery form, because these are the two coverages, right, that have retroactive dates and extended reporting periods. These two don't. So I can eliminate, again, 50% of my answers just by knowing this section. Okay. If you're going to my site, if you go to exam 2, question number 10, it doesn't say anything. It doesn't say liability, crime, theft, anything. It just says you have up to 1 year to file a claim. Well, anytime you have to file a claim within 1 year, that's loss sustained coverage. Okay, so that's how I got that there. Okay. If you're logged into my site, if you scroll down, I do have a webinar where I do dive a little more deeper into this. But I have occurrence made coverage. It's similar to auto insurance. The policy that's in effect when the loss occurs pays for it, even though you filed a claim later on. Okay, that's how that works. Like auto insurance. If you get into an accident today, but you don't go until Monday and file a claim, the policy that was in force today the policy that's in force today when you have the accident pays for it, even though you filed a claim on Monday when you might have had another policy with another company starting tomorrow. Okay. But claims made coverage is like health insurance, medical coverage. Let's say you hurt your back several years ago. You're feeling okay. You buy a health insurance policy. Today, a month later, your back's kind of bothering you. You go in and they say, hey, you need surgery. Well, who's going to pay for your surgery? The policy that was in effect 5 years ago when you first hurt your back, or the health insurance policy that's in effect now when you're filing your medical claim? Well, with health insurance, it's the one that's in effect now. That means with claims made coverage, right, we can go back in time and set a date that we want this policy to begin coverage. Now, the prior loss or the loss before you bought this policy must be uncertain, unknown. Because I mean, if you're setting a retroactive date just to include an existing loss, we're not going to pay for that. Because remember, losses must be uncertain. All right, so that's what that's about. Okay, so yeah, retroactive dates. Again, the definition: earliest date that a claim can occur and have the policy covered. Extending reporting periods gives you additional time to file a claim. Usually, it's 60 days. And then if for unreported or reported, but once it's reported, we cover your medical for like 5 years. Okay. If you're closing your business, you can get the supplemental extended reporting period, which is also called, like, instead of a mini, it's called a full tail or maxi. This is almost treated like a separate policy. And by adding this to the end of your policy, it gives your customers an unlimited period of time to file a claim and have this policy still cover the loss. Remember, with the extended reporting periods, we're not extending coverage. We're just giving you more time to file a claim for a loss that happened during this particular policy period. Okay, that's what that's about. This one's, yeah, it's like a separate policy, is a separate charge. The maximum they can charge you for this extended reporting period is 200 or 2 times your commercial general liability premium. Okay. So I hope that helps. But I mean, if you get this top section down pretty well, I mean, that'll help you out a lot. Okay. All right. What else we got? Any other questions? Oh, all right. So good luck tomorrow on your exam. The rest of you, good luck in your studies.
Actually,
Thank you
Yeah.
so much.
Oh, definitely. Thank you.
have a question. Hi, can you hear me?
All right, go ahead, Evelyn.
Okay, so this one's more specific on like a math question on like that come across. Is that oh yeah,
The
okay. So in
co-insurance?
the practice exams, I've seen a lot of like, hey, this apartment house is worth like 500,000 and like the owner insures it for 300,000 and it's like for the policy is like 80% co-insurance clause and there's like math to do with that. I've been trying to like come up with the answer that results in that just to see. I'm like,
Yeah,
okay, let's see how that worked it out. And I don't understand. I don't know if you know what I'm talking about. I have like an
of course
example
I
right in front
do.
of me if you
You
need.
hate math,
Okay.
right?
I love math. I just want to know how to do it. It should be easy.
All right, hold on. Let me pull. Let me see if I can pull a question up here. Actually, it might be. Let me go to. Let's see. I pull this up. I know. I think it's 118. Question 118 on this exam. Uh, Give me just a second. All right, here we go. Let's try this. All right. So it's going to be something like this, right? If the limits of liability on a structure are 75,000 and the structure is worth 125,000, how much would be owed on a fire loss of 50,000 if the policy has an 80% coinsurance requirement and disregard any deductibles? Okay. So you got to know the coinsurance equation. And the coinsurance equation is the amount of insurance you did have divided by the amount of insurance you should have had. Okay. So then you can break it down into a fraction, did over should, right? And you can simplify it because it does make it easier. Uh, and then you take that fraction times whatever the loss is. All right. So I'm pulling up one more thing here. Okay. So um, let me slide this over here. Okay. So coinsurance equation over here, right? So amount of insurance you did carry, which is how much insurance you bought, divided by how much insurance company the insurance says you should have had. So did divided by should times whatever the loss is. That's how much your company will pay on your claim minus any possible deductibles. Okay. Number one, you got to know this equation because that's very common that's a test question. What is the coinsurance equation? Another thing you need to know is what is coinsurance about? And in most companies require you to carry reasonable amounts of coverage to the value of the property, right? And so you need to know the definition of coinsurance. So now if I go back to this question, okay, and I break it down, the amount of insurance you did have is 75,000. That's a given on the test. The amount of insurance you should have is 80% of the value of the building. So if the building is 125,000, 80% of that is 100,000. So 75,000 divided by 100,000, I can simplify that's 3/4, right? 75 over 125 I'm sorry, 75 over 100 is 3/4. 3/4 times the 50,000 equals the 37,500 loss. So that's how much good. So on a $50,000 loss, the insurance company is only going to pay 37,500 minus the deductible. You have to pay the rest. So instead of, even though you had a $1,000 deductible, you got to pay more because you didn't have enough insurance.
Wait,
Now,
so you took the 75,000 divided by the 100,000, which
yeah,
is 80% of 125, and you multiplied it by what?
by the loss of 50,000.
By the loss, which is 50,000. Okay.
Yeah, so 3 divided by 4,
Well,
right?
this
3
is
fourths.
the equation I was using. I was like, maybe I was doing.
Yeah, you know why? You're putting the 125,000 is the amount of insurance you should have. You put the value of the building in the bottom part of the fraction. If the company says you only need 80%, then the bottom number should only be 80% of the value of the building.
All right, yeah, because I got that answer. I'm like, finally, something that matches what it says.
Okay. One, maybe two math questions if you're
That's
lucky.
good. That's very
Okay.
clear. Thank
Yeah. Now they might throw in the deductible. All right. So it's 36,500. It's 37,500 minus the deductible. So the company pays 36,500. You might get that one. And by the way, these numbers are common on your test. Okay. Or you might get this one. All right. So again, limits of liability and structure of 300,000. The building's worth 400,000. There's a $120,000 fire loss. All right. With a $1,000 deductible, how much will the policy pay? Well, you did have 300. You should have had 80% of the 500. So 300 divided by 400. Again, that simplifies to 3/4. 3/4 times 120,000 is 90,000. Minus the $1,000 deductible is your 89,000. Always remember the bottom number is 80% of the value of the building. Okay. Now, when you take the test at the location, there's a button, I think it's at the top, there's a drop down calculator. Okay. So, all right. Does that help out? A little bit
Sorry,
easier?
I had a question as well, another one.
Yeah.
So,
Go ahead.
when the test asks like which is an example of a monoline policy, that would be like just like workers' compensation and a commercial auto, right?
Just commercial auto. Yeah.
Oh, just commercial auto, no workers'
Yeah.
comp?
Workers' comp, because it's a casualty, so it covers employees, but it also has employers' liability, which covers people outside the workers' comp law. Um, that's a tough one. I don't know if they're going to give you that one as a monoline coverage. I know that workers' comp is not added to your normal package like your commercial modular policy. Workers' comp
Uh,
is usually kept as a separate policy, but I wouldn't classify that as a monoline policy. Commercial auto is the most common one that they use as a monoline policy.
commercial auto?
Yeah, because
Okay.
you buy it all by itself, or you can
Okay.
buy it all by itself. Okay. Yeah.
Okay, thanks so much.
Oh yeah. What else we got? All right.
Okay, I had one last question.
Bring it.
Um, so, for liquor liability, it's always excluded on a commercial, but it's not excluded on um, a business owner's policy, right?
No, the other way around. Okay, so now this gets kind of tricky. In the real world, okay, I train farmers agents and we can sell a business owner policy to restaurants that serve alcohol. That's the real world. In the test world, if that's a restaurant and it serves alcohol, you cannot cover it under a business owner policy. You're going to have to cover it under a commercial policy. Now, your commercial general liability section of your policy, or the commercial liability policy, right? Commercial general liability covers occasional liquor use by a company. That means if you have a quarterly kickoff meeting and you serve alcohol to celebrate, that's covered by your commercial general liability policy. Okay, because it's occasional liquor use. Um, but if you're actually in the alcohol business, manufacturing, distilling, transporting, or selling, then you have to get the liquor liability coverage.
Okay, so it covers hosting, but excludes like the
Hosting is
exposure
covered. Yeah,
of an
yeah,
insured who is like in the business of selling and serving
yeah.
manufacturing beverages.
That's different. Keep it separate. Again, like an office, we have an office party, we serve alcohol. That's hosting, that's covered. But if you're actually in the alcohol business or a restaurant selling and serving alcohol, you need liquor liability coverage because
Okay.
alcohol won't be covered in that case. Okay. But yeah, for the test, if you serve alcohol, you can't get a BOP.
Okay, thank you so much.
Oh yeah, no problem. All right. So I guess we will call it a day. If you have any questions in this next week, since I'm going to be sitting on a beach, email me questions as you study, folks. All right. But thank you for taking time out of your day and hanging out. Hope you learned a couple things, got some value. And again, be thorough with studying my material. Don't think that you can just do one or two exams and say, I think I got this, go take the test. No, you want to be thorough. Go through, I have 6 practice exams. You want to go through all 6, I'd say 2, maybe 3 times. You want to get to the point where as you're reading the question, you have an idea what the answer is because you're understanding the concept. I don't want you to go through it so many times that you memorize the questions because that's a tripping hazard there also. If you memorize my questions, you'll see that you'll take the test and the questions look pretty spot on in some cases. My question says which of the following is or are prohibited, but when you take this test, it says which of the following is or are not prohibited. So if you memorize, you miss the not because it looks the same, and then you pick the answer you're used to picking, but because they put the not, it's a different answer. And so that's where you can trip up too. So you want to, again, read it and do it enough to where you're comfortable with reading it, but still be a little uncomfortable to make sure you read the exam questions correctly. Okay. So good luck to all of you. Good luck in your studies. Have a wonderful weekend. And yeah, check in. And I want to know your results when you take the test, good or bad. Send me your results so I can work with you. If you didn't pass, we can work on how to best coach you to get you to pass. Okay. All
Okay,
right.
thanks so much.
You got it. Thank you. Thank you for your input.